And good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. Welcome to another Wednesday afternoon webinar. Joining us today is David Burrows, Chief Investment Strategist and our President at Barometer. And he's joining us live from our office downtown Toronto. And of course, in the middle of our conversation, we're going to bring on James Callahan, one of our key analysts, to talk about certain sectors that are working in our favor. With that, I turn the conversation to David Burrows. We will be addressing questions at the tail end of the discussion. So I know some of you have already sent some through via email. We'll be getting to those. And if you have a question during the call, hit me up on the chat. I'd be happy to address it with David. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you?
Great, thank you. How are you?
I'm well, thanks. I'll get to see you one of these days in person.
Yeah, exactly.
Thanks very much for kicking things off. Thanks everybody for joining us today. The world is slowly reopening. The vaccine is slowly getting out around the world and obviously various paces. We're still a long way from normal, but it is a contributing factor to an improving market. Certainly, there's lots of things driving markets, and I'm going to sort of try and cover some of them today. We got a couple of themes that we want to focus on in particular that are sort of reinforcing to our views of the world currently. But things do continue to change. And as always, there are sort of longer term structural themes. They are always impacted in the short run by events as they roll out. But oftentimes, there are bigger forces in the background that are harder to understand. So always good to touch on those. As always, I'm going to look at things through our lens. We're not trying to be everywhere. Our strategy is all about trying to identify areas of the market that have a tailwind, a long-term structural tailwind, where valuations can go higher, not just because conditions are improving, but because as investors understand that things are changing for the better, they're more comfortable paying higher multiples or higher valuations in these groups. So we're always hunting for market leadership. We will generally be quite focused in those areas. We're not going to own everything. We look very hard to recognize change, new leadership as it emerges and old leadership as it recedes, so we can change our portfolios as time goes by and keep them relevant. And then finally, there are those times when nothing's working. And in those cases, our job is to play some defense and hold some cash from time to time. So here we go. Let's just talk a little bit about what's going on. This is quite a tactical approach, as you know. From a big long-term thematic perspective, we think we started a bull market in 2013 as we exited a long-term structural bear market. Equity asset class became under-owned, was unloved. It had been a frustrating place to be for a lot of investors, other than some cyclical rallies and declines, much like it was after the 1966 through 82 structural bear market. And then we had an 18-year rise where the market went up 18% a year, obviously in fits and starts. The bull market continues. We have been working our way higher. We are another week along. We're now 39 quarters in this rally. But the bull market of the 80s and 90s went on for 70 quarters. It's a long time. Bull market of the 1950s and 60s went on for 49 quarters. So, that would be another 2.5 or 3 years. And that was a relatively short structural bull market. And of course, we do have some pullbacks along the way. The S&P has been working its way higher through some corrections, but certainly at the top end of the channel. We had corrections much like this going back through the 1980s and 1990s. NASDAQ exited its bear market in 2016 and continues to work its way higher again, sort of hugging the top end of the channel here, but in a very clear upward bias. From a rates perspective, I think people understand that we believe we've been going through a generational low in rates, much like we did in the late 1940s. And our premise is that what works in a reflationary environment is very different than what works in a disinflationary environment. And we really have to wrap our heads around that, because a lot of the assets that have really outperformed are assets that are helped by falling interest rates. So just think about real estate, and the cost to finance real estate over the last number of years, how that cost has fallen, enabling investors to pay higher and higher prices. What happens as rates slowly start to go higher? Is it possible you could see that asset class continue to perform well? When you look at the long-term average for real estate returns over a couple of hundred years, it's about equal GDP growth in the economy, quite different than the last few years. Bond prices have been falling fairly steadily since March. So this is the price of a long-term US Treasury bond. Our premise is that we are in a bear market in bonds. Bond investors get their coupon, but they're losing money on their capital. And this just continues, failing rally after failing rally. Again, this week we moved sharply lower in price or higher in yield. Now, this can go on for a long time because this is probably the most crowded investment on the planet. The bond market's 10 times the size of the stock market, and we have had money piling into bonds at record paces up until this past year. And we're only just now starting to see some flows out of bonds. And meanwhile, money was coming out of equities pretty consistently. So we're seeing a reversal in fortune. So as bond yields work their way higher, bond yields, that's not a great thing for bond investors. Prices are falling. And that looks like a substantial rise. So that means we got to 1.3% today on a 10-year bond. We were as low as 50 basis points in August. But when you put it in long-term perspective back to 1981, this may be only a beginning of a reflationary cycle, can go on for a long time. So we really have to think our way through the types of investments we have. Do they make sense in a rising rate environment? And the Fed's made it really clear that they would let inflation run hot because they want to make sure there's growth in the economy. We think we've been going through a generational bottoming in commodity prices. And as we've been discussing, we've broken this 10-year downtrend in prices. This is the XME index, which is the big base metals mining companies. This is the last 4 months, sharp increases. We've broken this trend and it continues. It's been a wonderful week for the miners. Freeport-McMoRan, which is one of our very biggest holdings, really had quite a stellar week. Rio Tinto had a very good week, raised their dividends substantially. All of these companies are coming in ahead of expectations. Lots of liquidity in the system. We've talked about all of the money printing that's been taking place. The Fed clearly is flooding the system and using their balance sheet to buy fixed income and other assets. There's lots of excess savings, roughly 1.6 trillion in excess savings in 2020, above the long-term trend. And probably this year we get another $1 trillion. So that's a lot of liquidity that can find its way into the market. It's not just money that is in the market today that we need to think about. It's what money could come into the market. So it could be money that comes out of the bond market and goes to a place where it's being treated better in the stock market. And it doesn't have to be in Google and Tesla. It can be in steady dividend growth stocks that will give them a rising stream of dividends, which would help offset a rising stream of a rising interest rate. We know there's tons of stimulus has come into the system, and fiscal stimulus that's proposed to be spent this year, roughly $1 trillion left of this first 3.3 trillion from last year, another 1.9 trillion promised for this upcoming year. And that's all happening because the Fed and the US government want to work on this non-farm payrolls number. Look how much lower we are than where we went into the pandemic still. And when we went through the financial crisis, it took a long time for employment to get back to previous levels. So they really want to work at doing everything they can do to accelerate the reemployment of those who lost their jobs. Now, the US dollar has been a big contributor. It continues to be sloppy. And that means that certain assets are doing well, people selling a safe haven asset like the dollar to buy assets that have pricing power. So emerging markets, the quick themes that we've been focused on. US has led since 2013. Global stocks over the last number of months have started to lead the market. Look at this is relative price strength versus the S&P for the emerging markets ETF, PIE. Or EEM you could look at. There's several others, but very strong, persistent prices moving higher. very strong outperformance, that is a weak dollar asset. This is the Chinese stock market making a new relative strength high. They're on holiday now, but from all accounts, consumer spending is strong. So we're seeing strength really all around. This is the Japanese stock market. In the short run, we've exceeded the highs from February of last year. But when we go out further, we're exceeding highs that go back to 1991. That's a 40-year bear market that this market had just come out of, much like the US stock market did in 2013. It's the beginning of a global bull market in equities. The Taiwanese market continues to be very strong. This is a market that's dominated by semiconductor manufacturing and other technologies. This is Taiwan Semi, has been a very strong, steady outperformer. And this is one of the companies that we hold. But that whole international global stock theme is one that continues to gather steam. So when we talk about yields going higher, that has implications for which sectors lead. This is the Canadian 10-year bond yield working its way higher since last summer. And below is the relative performance of the banks on the top versus REITs and utilities, or things that act like bonds, on the bottom. I've talked to a lot of investors who are still holding significant weights in REITs, utilities, consumer staples, sectors that are seen to be safe and insulated from the economy. And they're frustrated. They're getting their dividends, but they aren't getting anywhere near what the market growth is. And I think it's important to understand, if we're into a rising rate environment, different sectors are going to lead. So this is a picture of the KBE ETF, which is the S&P Bank Index. You can see this was the high back at the end of 2019. Important to note that we have just exceeded that high, and that's great. When we look at that on a longer term basis, it's great to see it break out. But when we compare to the long-term theme, banks have been in a bear market since 2008. So coming up on 13 years of no progress. But the fact that we have banks breaking out to new highs and the leaders always go first, it's an important tell that this group is getting into gear. Now, the banks are the most under-owned sector in the US market. As Canadian investors, we like our banks. The banks haven't had big disappointments for us. In the US, we know that's not the same story. Now, the leading banks will always have the best performance. Off the bottom and then continue on. So this is JP Morgan's share price. The highs back in February. We're well through the highs today. But if we do the same comparison to this time period for the whole bank index, JP Morgan made its first new high in 2013 and has continued to strongly outperform the bank index ever since. So many know that this has been our largest bank holding over the last few years. It's one that we've continued to add to. But it's important to recognize that just because something's outperformed for a period of time doesn't mean it ends. The first stock to double in a group in a bull market will be the first stock to double again. So it exited the bear market at $52. It's trading at 144. So the stock's tripled since it made its first new high, whereas the bank index is still yet to make its new high. So this is the leader. Morgan Stanley's another leader, easily exceeding the highs from last February, but actually just making new highs back to 2008. So much like the global stock markets that have been making new highs for the first time in 10 and 12 years, the banks are accelerating and making their first new highs. So this is new leadership in the group. So I've asked James Callahan to join us today to help explain why it may be that investors have a newfound interest in the banks after a long period of outperformance. Clearly, we try to focus on good getting better, not broken getting fixed. So we've been focused on things like Morgan Stanley and JP Morgan, but we have been increasing our weighting across the group because the backdrop is so strong. James, maybe you could talk a little bit about a couple of these themes.
Yeah, absolutely. And thanks for having me on, Dave. So I think just to set the stage, there are really two powerful macro tailwinds that investors need to be aware of when thinking about the US banks right now. So the first is higher rates and importantly as well, a steepening yield curve. And then the second is the lifting of capital return restrictions. So yields have moved higher over the last few months, and that's definitely helped the space. But beyond that, the yield curve has steepened quite nicely as well, which is really good for the banks. So if you look
the
at
yield
the US,
curve meaning the yield on a 1-year bond versus the yield on a 30-year bond, and the larger the differential, the more expectation there is of growth in the future.
Exactly. And so this is an example of the Canadian yield curve. But if you look at the US yield curve, what's happened over the last month is that the short end, so specifically the maturity is less than 1 year out. So on the left of this chart, the yields are slightly lower than they had been a month ago. And the yields on maturities 5+ years out are substantially higher. So over the last month, 10-year rates in the US, for example, have gone from 1.1 to 1.25, and 30-year rates have gone from 1.8 to 2.1. So it does make a difference. And it's definitely showing up in the stocks. So just to give some further color, and I'll start from the very, very basics, because you'll probably hear us talk a decent amount about the banks on future calls as the thesis plays out. So I think it is good to cover. Beyond credit cards and capital markets and asset management and all the ancillary things that the banks offer, the most important component of revenue is always net interest income, which can sound complicated, but it really is pretty straightforward. So if I'm the bank and it costs me 1% to borrow $100 for a year, and I loan Dave $100 for a year and I charge him 2%, Dave will hopefully pay me $102 at the end of the year, and I pay my lender $101. I keep the $1 difference, and that $1 is the net interest income. So this model, whether it involved the bank making loans to individuals or companies or really anybody scaled up, generally for the bigger banks in the US makes up around 50% of revenue. And it's a higher percentage for the regional banks. It's often 70% or higher. So now in an environment with a steepening yield curve, because I'm the bank and I'm borrowing on the short end of the curve and lending on the long end, I can borrow for less and I could charge Dave more. So it's much better for business. And if you think the yield curve continues to move higher, which we do, you have to own some banks. So obviously we layer in complexity on top of this through looking at things like loan losses, specific loan book exposures by industry and region, those sort of things. But to an extent, it really is that simple. And that's great. And it's probably reason enough to buy the bank stocks on its own. But the steepening of the yield curve is coinciding with the banks being able to return capital to shareholders again. So restrictions on capital returns in the US were put in place by the Federal Reserve last year in June when CCAR results were submitted. So CCAR, which is the Comprehensive Capital Analysis and Review, which is the bank stress test. It's done each year. Banks have to simulate exogenous shocks and then report on the expected losses to scenarios like unemployment rate jumps 15%, or I think the most adverse scenario was equity markets sell off 55%. So when those results were submitted last year, the Federal Reserve found the banks to be generally well capitalized, but still thought it prudent to restrict share buybacks and to put a hold on dividend increases. So as of Q1 21, the restrictions on share buybacks were lifted to an extent. So right now they're tied to 2020 profits, but we expect restrictions on capital returns to continue to be lifted throughout the year. And because the banks have very high capital ratios right now that were built up throughout last year, many have capital ratios well in excess of what is required by the Fed based on the stress test last year. So with economic data improving and people getting vaccinated and back to work in a lot of places, especially in the US, these capital ratios are going to come down and it's going to benefit bank shareholders. So for example, if you look at the 17 largest US banks, on average, the amount by which their current capital ratio exceeds their required capital ratio, it works out to about 16% of market cap. So it's a huge number. And obviously that's not all going to get dispersed at once, but that amount will compress over time, and it should give a nice bid to a lot of the names as they buy back shares.
So James, they can use that capital obviously to lend out, and in the current condition, the opportunity to earn a profit lending that money out is much greater than when the yield curve was flat or in fact inverted briefly last year.
Absolutely.
They can raise their dividends, which would create some dividend growth, which we haven't seen for a while from the banks. And then they can buy back shares, which reduces the number of shares you're spreading the earnings over. So it's really, you win three ways.
So to talk about our specific exposures, I know that definitely want to highlight Morgan Stanley. So that probably is the least levered to net interest income out of all of our US bank exposures. For them, it only represents about 12% of revenue. But we like them because of their capital markets and wealth management exposure. By all measures, 2020 was a great year for the investment bankers. Both debt and equity issuance broke records and really carried the day from a profit perspective for a lot of the big US banks. Morgan Stanley was right in the middle of that. So they have a big wealth management business as well that we like. And then another exposure, which is more targeted and is particularly interesting, is Silicon Valley Bank. So they specialize in lending to early stage and private equity backed companies in Silicon Valley. Many venture capital investors will only allow portfolio companies to deal with Silicon Valley. And Silicon Valley Bank does something that's unique among regional banks. They often require the companies that are looking to borrow from Silicon Valley to issue warrants that are then held by Silicon Valley Bank and able to be exercised as that company hopefully grows and prospers. So they get to clients early and they're able to sell more products and services in as the company grows. Loan losses for them are minuscule, and the warrants that they get are a nice sweetener.
Just to make a point, good getting better. This bank was trading at $50 a share in 2008. It's trading at $500 a share today, $530, up 10 times. So the idea that you should be afraid of the one that does the best is just dead wrong. It often means their business model is better, their people are better, their systems are better. JP Morgan spends more than anybody on IT. Their systems are great. They've got great people. They continue to win. The winners generally continue to win. The losers generally continue to lose. You compare to, say, a Wells Fargo that has been a perennial underperformer. Some reasons to own that for a turnaround, I suppose, but we prefer to focus on good getting better. And so really Morgan Stanley, JP Morgan, and Silicon Valley Bancorp would be good representation of that. James, Silicon Valley is up 21% this month. What's happening with the estimates for earnings? Are they continuing to improve?
Absolutely. They are for the rest of the year, and then with the rest of the space into next year and the year after.
Right. So thanks, James. I really appreciate you coming on. I mean, this is sort of a poster child for what we're trying to do, trying to find groups that have become underowned, that are unloved, where there is a structural change taking place that benefits them. The fact that the yield curve is steepening and long yields going higher, it's the beginning of something that could go on for a very long time. Dividend growth has been held back. Share buybacks have been held back. This change in theme is something that could go on for a long time. And that's without expecting consolidation in the industry, which can happen at the regional bank level. And clearly a better economy will impact their loan losses and so on as we go forward.
Thanks,
so
Dave.
Dividend growth is a core theme for us at this point. And it's one I think when investors should really be focused on. This is the Dividend Growth ETF. It's an ETF of companies that have had a history of raising their dividend consistently. And you can see that since the late fall, the relative price performance versus the market has been remarkable. And when we compare that to high dividend payers with low growth and low economic sensitivity, like the utility sector, relative poor performance since then, and that would be the same for consumer staples and for REITs as a whole. Now, staying on the weak dollar theme, we talked about this a couple of weeks ago. Bitcoin, I think when we put it on, was about $37,000 versus US dollar. Last week, it had a very good week, moved to 45,000 this week. This afternoon, Bitcoin trading at $52,000. It's remarkable, but I want to keep it in context. When Bitcoin broke out in the beginning of the last move in 2017, it had a very substantial move. It looks like we've probably only just begun this leg higher, and you could see targets, well above $100,000. This is one of the things that we're invested in. We're not over invested here, but we do think that institutions are adopting Bitcoin as a potential holding. Asset managers banks, payments companies starting to use these, and corporations starting to put Bitcoin on their balance sheet as an alternative to cash. And we heard about Tesla doing that recently, and MicroStrategy is another company that's done that. So given that there's a limited quantity, this thing could go on for a while, and we want to participate. So just to be clear, we follow our process every day. We use our bottom-up security selection process to try and identify securities that have some kind of acceleration going on in their business model, in the revenue line, and in their cash flow. There's about 20 metrics that we look for. And we look for price appreciation that would support what we believe is happening fundamentally. And we always have a farm team of companies that we've done the due diligence on. We then pare that list down to only be securities within groups in the market that we see money getting put to work, where we see that there's a tailwind. Now, that could be a specific asset class or geographic region or a sector or a theme, where we can find leadership themes and they line up with securities that meet our business tests. That's where our portfolio lives. And then we don't try and guess at when something might run out of gas. We just follow it along with stop losses and use that to make our exit when the time comes. So at the end of the day, it's all about finding groups in the market that are seeing expanding breadth where more and more securities are participating and focusing in those areas. When we see deterioration in breadth, like we have recently, and things like REITs, for instance, or consumer staples, that's a reason to reduce our weights and not put any new money to work. In our models, we're seeing continued improvement. The S&P, after a little bit of consolidation in the fall, is working its way higher in a fairly orderly price pattern. We're seeing the same thing in the NASDAQ 100, very clearly in this channel. We're not trying to guess at where it might stop. In fact, we think this is going to be a very good year. We think we're headed into the first year of a 4-year business cycle. And we measure that using our breadth models. Our breadth model for the Canadian market continues to slowly improve. For the US market, continues to slowly improve. And in the past week, the global breadth model, after a brief reversal down 3 weeks ago, turned back positive. All of our short-term indicators are showing improvement. The percent of stocks trading above their 50-day moving average is expanding. The percent of stocks with upward price trajectory or momentum is expanding. The percent of stocks making new highs versus new lows continues to expand. And the percent of stocks trading above their 150-day or long-term moving average, it also continues to expand. There are no bear markets that ever took place while this is occurring. So it can change. We could see shifts in these, and if we do, we'll change our stance. But as it stands right now, things continue to improve. We know that when the percent of stocks trading above their 200-day moving average gets above 75%, meaning most stocks, that it can last a long time. And I showed this last week. You can have 200 days. You could have 150 days. We're sitting at about 70 days. So we don't think that we are near a significant correction, but we'll watch every day. A couple of things that happened over the course of the week, just to continue to focus on earnings. 392 companies have now reported in the S&P for the fourth quarter. Average companies beaten revenue estimates by 3%, and they've beaten their earnings by 18%. That's a good quarter. I'm very proud of our analysts. When we look at our companies, 51 of 68 US companies have reported. Average companies beaten the estimate by almost 5% from a sales perspective, but as opposed to an 18% beat for the S&P, our companies have averaged a 27% beat on earnings, and the price performance coming out of earnings has generally been positive, where for the S&P, it's been generally a sell the news story. And I think that has to do with our sector weights. Our sectors are sectors that people generally under-own currently, and that's leading to performance. We've really had a great start to the year. The equity fund's up 18.5% in the first 6 weeks of the year. Equity pool's up almost 18. The global pool is up almost 27% as of today. Long short pool's up 16%. And that's on top of some pretty strong returns for last year. Equity pool up 53 and long short up 61. So let's wrap it up. Flows are very strong into global equities. And some people point to that and say, well, should we be worried? What I would point out is that since 2018, we are in a significant reduction of global equity weight. And the fact that we're seeing new money come in is only just partially replacing the money that has come out of global equities since December 2018. And yes, some money's coming out of the bond market, but it has only just begun to come out from the largest bond buying binge in history. So here are annual mutual fund flows over the last number of years. The inflows could go on for a long time. From a valuation perspective, in 2000, the percentage of the market cap of the S&P that had a negative earnings yield was 80%. 80% of companies had a negative earnings yield. Today, only 12% have a negative earnings yield. The valuations are much more attractive today than they were in the late 90s, and the price performance could go on for some time. From a sector weight perspective, not much changing. We are bumping up our financials weight as the financials are breaking out. So we do have a fairly significant weight relative to the S&P financials weighting. We've taken our consumer discretionary weight up a little bit because as we get closer to the end of the pandemic, people seem to be prepared to spend money. We've taken some profits on materials, but you will see us likely trade this group a little bit more because it's a little bit more cyclical. So we watch for signs of weakness. And if we get it, we'll get defensive. But at this point, it appears to be sort of steady as she goes. And we'll continue to update you. So with that, Pam, if there's some questions, maybe we can answer them.
Hey, thanks so much, Dave. Great overview. And thank you, James, for joining us this afternoon. We had a brief overview of Bitcoin. And this question comes from one of our investors wondering what your thoughts are on ESG portfolios on their Tesla holdings, given Bitcoin's energy usage and the relationship historically of Bitcoin's tied to criminality in the underworld. If you could just briefly comment on that, that would be great, Dave.
That's a big question.
Obviously, things are changing. We have lots of adoption in that space. So
yeah.
Forward to
so look, at this is a space that is going to see increased regulation. There's no question. And there was a component and has been a component of some people using Bitcoin because it was difficult to trace. However, you can build regulation. The exchanges are seeing increased regulation. It would be good for all of us to see that piece of the market reduced. And so I would expect to continue to see this. The Fed made it very clear that they see a future for cryptocurrencies. And so at this point, I don't think that is something to be concerned about. Although if you were using it for the wrong purposes, I think that you have to expect that you're going to hear footsteps. When it comes to ESG and power usage, yes, you use power to produce Bitcoin, to mine Bitcoin. But long term, the financial services industry, as an intermediary between a buyer and a seller, burns an unbelievable amount of energy to facilitate being the middle person. And the whole concept of a cryptocurrency is to take middle people out of a transaction, to be able to settle a real estate trade between a buyer and a seller without a middle person. So I don't believe it's as simple as just saying it costs energy to mine Bitcoin. Once it's mined, it's mined. And it does cost money to manage the ledger, the distributed ledger, or the blockchain of ownership. But I think it's not as simple a question as, is it using energy for that purpose? And ultimately, Tesla are a very environmentally conscious company. They are using, for instance, using trapped natural gas in the ground to generate their own power for production in some of their production facilities. So, I think that on many different levels, Tesla is an ESG-based company.
Thanks so much, Dave. Quick question, thoughts on Enbridge? And in general, I know we have low exposure to oil and gas. If you could just comment, it was a name I believe we had in the portfolio last week. What are your thoughts on it?
Yeah, look, we do have an energy exposure, and our energy exposure has expanded depending on the portfolio. Our exposure largely is to natural gas producers because natural gas pricing obviously has been strong with the weather. So companies like Tourmaline, for instance. Enbridge as a company within its industry is a very, very disciplined company. They have very disciplined metrics that they use to decide on new projects. So that's good. It's just the industry is still somewhat challenged. And so that's a reason why we don't have even close to a market weight in that sector. Good company, difficult neighborhood.
Thanks, Dave. Quick question on gold. Where do you see it going in the weeks ahead? Any comments there?
I think the comments that we've made recently are that the long-term picture looks very, very attractive. It has been consolidating over the last number of months. Silver is performing better than gold is, and has sort of broken out prior to gold breaking out. Platinum had a very, very good week this week. Other commodities like forest products, copper are all having it. So as a group, the breadth of the advance for commodities is expanding, not contracting. I would expect gold to follow along in that theme.
One more question, Bitcoin related. What are our thoughts on investing in blockchain technology?
I think you have to be looking at it. It's something that's interesting, and a lot of the companies that we're invested in fintech are participating. So we know that a lot of the payments companies are adopting Bitcoin as a payments option, and there are technology companies that are specifically in that area. If you look at the BLOK, it's an ETF that owns blockchain technologies. See if I can throw it on the screen. It's one of the best performing ETFs on the street, and it's one that we don't own currently. We actually own the Bitcoin itself, but it's having a very good go. So this is a theme I don't think that's going away anytime soon.
Great. Well, thanks so much, Dave. I appreciate your answers and obviously your thorough overview, and so do all of our investors and prospective investors that are watching this afternoon. So thank you, and I will leave you with the last word.
Great. Well, Pam, thanks very much. I want to thank James for joining today. What we're going to continue to do is try and drill down on these themes that we're focusing in and why it is that we think that these are still relatively early stage themes, and really try and encourage people to look at the things that they own through these lenses to say, if rates slowly work their way higher, if we slowly get expansion in the economy on the other side of this, if they continue to stimulate both through fiscal and monetary policy, will my investments hold up? And I do get concerned that some of the most conservative investments that are held by the most conservative investors are most vulnerable to the impact of rising long-term bond yields. And so this is not something that people have to take a big binary step, black or white. It's shades of gray. And I think that we will see investors slowly reposition their portfolios into some of these areas, and when it starts, it can go on for a very long time. We just want to participate, be involved. So thanks everybody for tuning in today. If you've got any additional questions, certainly send them along. If you'd like to have a personal conversation with someone from our investment team or one of our investment counselors, we're happy to organize that. And barring major changes, we'll be back next week on Wednesday and hopefully have some interesting things to talk about. So thanks for tuning in.